Hi everyone, welcome back to the Market Chat. My name is Richard Moglen, and joining me again is Jim Roppel, hedge fund manager and crypto fund manager as well. Always a fun time when I have Jim on. Really get some very interesting discussions, and it's always great to pick his brain and learn from his vast experience. So Jim, first of all, thanks so much for coming back, and it's great to kick things off the new year with a great podcast guest.
Dude, thanks for having me. I love doing it.
Perfect. And I know we've done a few of these before. I probably asked this question a few times, but there's probably some people new who haven't tuned in yet to the previous one. So could you kind of run through a little bit about your experience, your background, just so kind of people get a sense of, who you are as a trader?
Okay. Grew up, I just went by the house I grew up in. My dad bought it for $7,000. I had bad grades. I'm dyslexic and, had a tough time in school, not academically inclined. But in college, I went on a learning disabled program. I met two guys who were really, really into the stock market, and I kind of fell in love with it. And the crash of '87 happened because I graduated. I took 4.5 years to get out, and we had the crash in October '87, and I graduated in that semester. And I went on an interview. I got hired on my first interview as a cold called stock jockey, and I didn't know a thing. They threw me a Haynes crisscross directory and said, cold call this thing. And then over about 10 or 15 years, I built up a book of about $150 million, working for Morgan Stanley. Really I was a square peg in a round hole because I cut my losses and I concentrated people's money as opposed to, a hedge for ignorance. I spread it all, they just want to rake in the fees and don't in this litigious society. They're trying to avoid lawsuits, and I was completely the opposite. And it became a problem. And I was making more money in my own personal account than I was from commissions. And so I quit and opened my first hedge fund in 2004. And I started with like 14 million, and now I'm running over 200. Well, that includes the crypto fund too. It's not all equities. And that's the deal, my friend. I've been around for about long. I'm becoming an old timer now. So that's it in a nutshell.
Perfect. And obviously, everybody who knows you knows you've been incredibly inspired by William O'Neil, the CANSLIM methodology. That's kind of that kind of forms your overall methodology.
Well, let me back up. When I was a cold call stock jockey, I'd call you up and I'd say, hey, Mr. X, can you, if I give you a great idea, can you put 25,000 in? And I did that for years, and everything blew up. I was the worst. I had no clue what I was doing until one day I saw the newspaper at 7-Eleven, and I read the paper, I read the book, and I knew this was for me. And then from that point on, like the first thing, job one I learned was cutting your losses. And my performance immediately went up. Like I didn't have it by any stretch figured out, but like when I eliminated the big losses, I did pick some winners. It was a game changer. And then, Bill taught me to employ better selection criteria. I didn't know it. I'd never really even seen technical analysis before this. And this was in like 1994-ish. And that was it. That was the beginning of starting to make money and at least having some clue what I was doing. Like all my success is directly attributed to Bill O'Neil's teachings and my persistence. Most people with the string of losses that I had would have given up way before. So I owe everything to Bill, everything.
Absolutely.
Bill O'Neil, you're the man. Thank you.
Perfect. And in my head, because we're kind of starting off the year with this podcast, I had in my head that we'd be talking about basically what are your main ideas for 2021. But obviously, we've started off the year with a pretty much a decline in the indexes, and even though we've had a bounce today, it's interesting. I think the Qs were down 2%. So I'd love to just kind of hear your overall thoughts on the market up to this point, and what you think's in store with everything that's happening with inflation, the Fed, putting that all together. What are your thoughts on the market right now?
Well, I'm going to go with what the market thinks is going to happen. And that is, listen, rising rates are kryptonite for equities. I'm not at all convinced inflation's real because I don't know what the real problem is, because tips are going down and the dollar's going down. Well, that is clearly saying there's a lot of disconnect between historical correlations between equities, bonds, rates, it's not functioning properly. So in a market like this, I'm 100%. I have one position that's probably a little overhedged actually. And I'm out. I'm out. And if you talk to me in a month or 2 or 3 or whatever, and I say I'm short, the bottom's in, because I'm such an optimist. Okay. I mean, if I go short, and I might be right, a stock, maybe I'm short at 100, it's going to go down to 25. Well, it's not going to go in a straight line. It's going to have some bounces. The first bounce, I'm going to go, oh, the whole market's turned up, and I'll cover. So it's way better for me to stay out.
Yeah. And just so kind of we're clear, given that the market's very choppy right now and all of that, what are some rules that you're kind of following that makes you basically determine that right now cash is kind of king? It's not really the time to be trying to buy the dip and buy all these pullbacks that we're seeing in a lot of growth stocks.
Well, I think this is the first time we've been below the 200-day moving average for any period of time, for a great deal of time. But nothing good happens when indexes are below the 50. And almost every the S&P may or may not be. I didn't see it today, but it was right up just a little above. It's probably down below today or close. But the growth indexes are being obliterated by Fed compressing valuation. Now, listen, I said that's what the market thinks is going to happen. I'm not convinced. Number one, I'm not sure inflation is the real problem. Maybe valuations just got way out of whack, but you have a plethora of leading stocks that have zero earnings in the cloud space. You have tons of stocks that have no earnings. Tesla's trading at 200 a million times earnings. Rising rates are kryptonite for that. Now, one of two things may happen. Inflation may not appear and the Fed may back off, or the market may throw too big of a tantrum and the Fed may back off. So I'm not convinced at all that what is happening, what people think is going to happen, is going to happen. But I don't care. The trend is down, and that's all you need to know. I mean, dude, how many monster growth leaders have blown up 40%? We're in a bear market in growth. Anybody who pays attention to moving averages in the stock price and percentages up and down, or gains and losses, is got to admit we're in a bear market. Right. At least today.
Yeah, for sure. Today we saw a lot of distribution, even in some of the stocks that have been bouncing well in the EV names that I've been watching. Ford, I think, faded off its breakout. Lucid gave back, I think, 8%. So even that kind of one remaining growth leadership group got hit pretty hard today overall.
It's time to get your sunglasses, go to the beach.
There you go. And I want to ask you just in general, because I think it's something that's not emphasized enough, is the importance of the Fed and how powerful they can be in directing the longer term movements of the market. So I'd love to hear kind of your breakdown on how the Fed and interest rates basically influence the action of stocks and leading names as well.
Well, a lot of people call it the DDF, dominant, or DFF, dominant fundamental factor. And right now, clearly, the fundamental factor is, it's not Unity's amazing fundamental story. It's not Tesla's fundamental story. Fundamental success stories mean nothing in this rising rate environment, or the Fed jawboning. Okay, they're bully pulpiting the market down. That's the dominant fundamental factor. And in almost all environments, it is the dominant fundamental factor. So at different times, different things are. I mean, when I became a broker early on, it was the twin deficits, the trade deficit and the budget deficit. You don't ever hear anybody discuss that today. Okay, if you look at the Crane shares high yield Chinese bond ETF, it's imploding. It's like 30% below the 2020 lows. No one's talking about it. It's not even close to the dominant fundamental factor, although I think it's impossible for me to believe that what is happening in the Chinese commercial paper market, it's seized up. It's basically not functioning, and no one's talking about it. I think that could end up becoming a dominant fundamental factor, but right now no one cares. So it's whatever market you're in, whether it's oil driving the market, the Fed, innovation, agriculture, whatever it is, you have to be aware of that at that moment and to stay in tune. Always find the fundamentals that corroborate the current trend.
Mm-hmm.
And that's going to be your dominant fundamental factor. So that's my opinion.
Yeah, perfect. And I also wanted to touch a little bit on how things are affecting crypto, because it seems like that's, along with growth, that's taking a significant hit. And obviously, we've talked before about obviously you manage a crypto hedge fund. You're very, very well attuned to that space. So I'd love to hear your take on what's going on over in that market as well.
So when I became introduced to crypto through my past partner, Matt D'Souza, who unfortunately passed away, miss you, Matt, crypto was touted as non-correlated to equities. And it wasn't. It had not been forever. But in the last 6 months, crypto has started to trade like a small cap, no earnings growth stock. And it's extremely correlated to equities. And I think it's almost like, because it trades 24 hours like a currency, it's like S&P futures over the weekend. Like I can kind of tell what the market's going to do on Monday by how it trades over the weekend.
Right.
But I am a raging bull on crypto. I think it is the most disruptive technology in the world. It's currently approximately a $2 trillion market. Equities are, call it 100 trillion, bonds are 200 or 300 trillion. I think that the legacy financial system is being disintermediated by crypto, and many other industries will be. But if crypto is 2 trillion, I think it's going to eat equities like software is eating the world. I think crypto is going to eat the world. Clearly we're in a bear market, and crypto is kind of a nebulous term because they're so much deeper. This is really, we're in about the end of a garden variety pullback in crypto. When this ends, I just think so much money I think more money is going to be made in crypto as it almost supplants equities. That's my opinion, and I'm backing it with my net worth. I mean, I have an enormous position in crypto, so I'm talking my book also. You should be careful.
Yeah. And speaking of crypto, what do you think are some key coins that basically people should be focused on and should do their research and learn more about, that you think have a lot of potential in terms of disrupting current technology?
Okay, well, obviously Bitcoin and Ether, but Ether doesn't scale that well. But most projects are being developed on Ethereum, and Ethereum may end up scaling. But I feel that the real Google or Microsoft of crypto is not really known yet. And I think that several of these altcoins are going to grow up to be wildly larger than Bitcoin. Bitcoin's a $2 billion market cap. So is Microsoft and Apple and whatever. Tesla's 1.7 billion.
Right.
We're going to see multiple single $1 trillion coins come out of this. Now, say there's 5,500 altcoins or total cryptocurrencies. They're really software projects. We just call them software companies. 97 or 8% are going to go to zero. Just like when the dot-com bubble was building and it popped, you ended up with a handful of stocks we all know today by name. But all the IPOs that were coming out, they all went to zero. The exact same thing is going to happen. The roadmap for the build out of the internet is the roadmap for the build out of the crypto, DeFi, blockchain world, except it's just happening at a much quicker pace. The rate of adoption is radically faster than the internet. It's going to be bigger. I don't know if it's going to be bigger than the internet, but it's going to eat the internet. It's going to eat crypto software stocks, crypto coins are going to eat traditional equities. And I really think the place to be for the next 5-10 years is going to be in crypto. But I think a huge amount of money is going to be made in stocks too. I say this all the time. As long as the golden goose of capitalism is not suffocated by socialism, there's going to be another BlackBerry, another Starbucks, another Apple, another Tesla. It's just they're coming from America. Okay, we have a couple out of China, but China's financials are very you can't count on them. They're not that transparent. The big monsters are coming out of America. America's a one-way street. People are coming here, technologists are coming here, the innovation is coming here. We control the world through our military, our free market system, and it's never going to stop. So don't count. Equities are nowhere near over. But I think there's going to be bigger, or just as big opportunities in crypto. And here, right now, when I started, when I started my crypto fund with Matt in 2015 or 16, I can't even remember now. People said crypto is for illicit activities, money laundering. It's a scam. It's, people didn't even believe it was real. Now you have really qualified market strategists at major institutions saying everybody should have 1-2% of their money in crypto. What happens when they go, you should have 25%? Now, crypto's not gold. Crypto has utility. So when someone says you should have 5% of your money in gold, it has no real utility. I understand that. Crypto with utility, why couldn't you have 40% of your money in crypto? And people are talking about 0 to 2% right now. What happens when the crypto space goes from 2 trillion market cap to 50, 80, 100 trillion, and market strategists go, you should have 30% of your money in crypto? What's the value of your account going to be if you put 20% in it today and you get a few right? How about that? That's a long answer.
Perfect. No, that was great. And I think one of the main, I guess, dangers, but also just kind of criticisms with investing or trading crypto is kind of the volatility that can that can happen. So I'd love to hear kind of your process in handling that. Do you make your buys any different? Do you basically make your sells any different? How do you kind of manage your positions when trading it because it is so volatile?
All right, you're 100% correct. The volatility, these trade like micro cap or venture deals that are public or free market trading. And I always manage my risk from my initial cost. But once I'm in, I'll let it go all over the place. Like,
Mm-hmm.
you have a lot of people who talk about mental capital preservation and drawdowns and all that. If you really pay attention to that, you're never going to be up 400% in anything, because you will sell before the drawdown ends and you won't be there when it goes back up. So ideally you want to get in when the market is in a really big drawdown like it is now. Wait for an upturn. Don't ever, try to pick a falling market.
Yeah.
But once you get into an uptrend, try to, position yourself. And if you get it right, and, number one, always cut your losses on your initial position. Always, always, always. But in crypto, the volatility is so enormous, you can't use a 3 or 4% stop loss if you're going to try to hold something for a great deal of time. So open up your stops at maybe 10%. Try to get the bottom, the upturn from a bad bear, and then just sit and hodl. Now, I will not I will trim great levels of extension occasionally, mm-hmm. but it's very tough.
Yeah.
So you have to look at historical levels of extension for the coin you're in and crypto in general, which is far greater than equities, and try to trim off maybe 10, 20, 30%. But this is such an explosive environment. I'm much more concerned about not being in than the drawdown. So there's a long answer. All right.
Yeah,
Number one, it's always job one to cut your losses, but the volatility is so high, you have to open up your stops, pyramid in after a bear into an upturn, and then just sit and expect a 10-year build out that took the internet 15 or 20 years to build out. And I think if you can do that, you're going to make I believe you'll make life-changing money. And I'm positioned that way personally.
Perfect. And just looking at the technicals, it seems like the coins trade very well. So even if you're not trying to just invest for the long term, it seems like there's a lot of opportunity to catch some really significant trends as well.
I agree. The technicals work really, really well with crypto. I was, when my partner Matt first showed, well, I was actually charting Bitcoin before he brought it to me, but I really started to focus heavily on it. He lived with us when he was recovering from cancer. Mm-hmm. And that was when ETH and Bitcoin had these really long, perfect, tight bases. And I'm looking at this, I'm like, oh my God, this is going to break out. I was doing this when it took like 6 weeks or 8 weeks or months to open up a Coinbase account. I would literally go to the bank, big stacks of cash, and give it to my partner Matt, and he would then send me coins to my ledger. That's how I got into it. This is a long time ago.
Yeah. Yeah.
But they trade really well on technicals.
Perfect. And do you use kind of, because I know the 50-day moving average is kind of your classic guardrail for stocks. Do you use a more longer term moving average when it comes to Bitcoin because of that increased volatility?
I do. The 150-day moving average seems to work really good for Bitcoin, although it's below it right now.
Yeah.
But I don't. I just feel taxation is such an enormous drag on performance, and my cost on these coins, on a lot of them, is so low. I can really take a big drawdown. And again, a lot of this is where psychology comes in. People can talk big and say, "Oh, I can take a 50-60% drawdown," but when it happens to them, they tend to puke. So really knowing yourself, how dear is money to you? Are you counting on this money for something, or are you just trying to, compound out over 15 years? So make sure, if you say you can handle a 50 plus percent pullback, that you really, really can, because the market is going to expose your weakness and it will call your bluff. I guarantee you. After 30 years, that's one thing I know. Markets are going to expose your weaknesses, your shortcomings, and it's going to call your bluff.
Perfect. Yeah. And I guess one way that if you do feel like that you can't quite handle a drawdown like that, you could position size. If you really want to be involved, just position size accordingly so that doesn't feel quite as sharp as if you're just doing a normal position like with the stock.
Yeah, for sure. Position sizing is always important, but even probably a lot more so in a higher volatility environment. But really selling the extremes with portions of it, and to dampen the pain of the drawdown. I'm much more interested in selling the extremes. That's really what my solution is. But it's talking
tough.
about it and implementing is very different, and
right.
it's hard.
Absolutely. Perfect. So Jim, I wanted to switch back to the markets a little bit and just kind of talk a little bit about 2021 in general and how basically you traded the year, because it definitely was choppier for traders. We obviously didn't have those really extended trends like we saw in 2020. So I'd just love to hear kind of how the overall year went for you and kind of your big takeaways from that entire basically year.
All right, like, are you the priest and I'm going to go to confession now? I had a bad year last year, and it was partially because I had such an enormous year in 2020. Right. My ego was rocking. When your accounts are ballooning up, you feel like Superman, and it's like intoxicating. And then I failed to acknowledge the declining AD line that started in February, March of 21. So you had a silent bear market, which was not really noticeable. It was very subtle, but breakouts were like Snap was a 99 comp O'Neil stock, which failed almost every single time. And that was really like the poster child, because two people did great last year: short-term swing traders who sold breakouts and ultra long-term holders. But if you're an intermediate term trend trader, you were chopped to ribbons. I was stopped out at 29 to 34 stocks by the beginning of fourth quarter. So I was down. And I failed to acknowledge that declining AD line. And I think what was happening was the market was starting to anticipate Fed tightening or some type of problem. And high PE growth names were starting to get squeezed and getting choppy. Now, also, in my quest to not pay taxes for my partners and push the gains out a further year, I had all the monsters. I had Zoom and Roku and Trade Desk and, name a couple others. So it was pretty obvious to me that in early 21, the market had topped, but I didn't want to pay the tax. So I employed a hedging strategy in a bunch of those names. And, although I've been trading, I kind of got started in an options shop when I first got started, my second job as a broker. I was not pure hedging. I was hedgelating. So when the market would turn up, I would take a bunch of the hedges off. And what that did was it left me long, not the elite names. So I would buy some of the elite names, but I also had extra exposure in the unhedged past leaders, because I thought it was foolish to be hedged in an upturn. So the bottom line is, if you do want to push your taxes out, make sure you have a delta neutral hedge, which means it's at parity with the market, or you're one for one hedged, and you don't hedgelate and you don't take it off and you leave it alone. I'm not smarter than the market. So God forbid you start trying to hedgelate into a slightly downward trending market. Now, the real issue was the market went from a silent killer to November, December, if the market just broke wide open. The AD line was going down like this, and then it just went straight down in November, December. It became obvious. We had a waterfall moment in SaaS stocks, enterprise software, and it's just continuing now. But it's obvious. It's not. No one's hiding. The Wizard of Oz has been exposed. The market's in a high growth, disruptive, innovative, high valuation stocks are in a bear. At least they are right now. Now this could change. We could get a follow through day. Mm-hmm. And I would have to probably test it. But when the market's being led by copper, soap, you have charts, right?
Yep, I've got charts.
Anybody look at a chart of Church and Dwight? They make soap, condoms, things you want in your bomb shelter. Why is that stock acting like a growth stock? Okay, copper's going up. Mosaic is breaking out. Mm-hmm. Semiconductors have held really well. Micron looks fantastic. AOSL, whatever, looks really. Now that's really a micro cap stock. But today the semis they got right up to the top of their range and reversed. Now Micron didn't reverse too hard, but Broadcom did. Look, semiconductors are the last high growth area holding, and if they break out of the bottom of this box they're in, now there's really nothing left. I mean, you have Ford. Yeah. But I look at the market and I usually say, do I have envy? And do I wish I was in some names? And right now I'm elated I'm in cash.
Right.
Okay. So I'm a really impulsive buyer in uptrends. I mean, it doesn't take a lot to get me to go because I'm always bullish. I think it's going to turn up, and I have no desire to be in this market at this minute. It's in a downtrend. I mean, there's a lot. Listen, you want to talk about Roblox and how many average daily users they have and the explosive potential there is there. Unity software, all these fundamental stories are amazing, but in a downtrend, it doesn't matter when valuations are being compressed. It just doesn't matter. If you told me, Jim, there's a company that is minting $5 million gold bars and they're doing it for 3 cents. If the market's in a downtrend, that does not matter because there's a liquidity issue. Money's coming out of the market. Fundamentals don't matter in downtrends, and that's what we're seeing right at this minute. Yeah, that's a long answer.
No. I think that sums it up really, really nicely. And I guess the next question I want to ask you is, given that we are in a downtrend, what are you trying to do right now to stay on top of any potential ideas that if we do get a nice move up and the uptrend looks like it's resuming and we get that fall through day, so you're on top of those potential new leaders?
All right. I think normally I would say screen for relative strength leaders. But the problem is that the stocks that are showing relative strength at this minute are probably not going to be the stocks that are going to lead in the next upcycle. Yeah, so I would really be screening for monster earnings growth, like APPS or, now the real true leaders are going to turn up probably before the bottom and the follow through. Then I don't know how bad this is going to get. Okay. Like I am very flexible. Yeah. But let's just say we do have a normal downtrend like you see in a Fed tapering moment, and the indexes break and we see the indexes go down 15%. They'll bottom, but the real monster leaders, like in the bottom of the 2000 bear market, E-Research came out like 3 weeks before the bottom, that accumulation distribution on the IBD indexes, the Dow, S&P, and NASDAQ, were A+ as the market was like making a low. So there was big accumulation occurring, even though the market was making a low. The exact opposite is happening right now. I believe the accumulation distributions before today were E, D-, and D-. Again, you couple that with the market living below the 50-day, not much good is going to happen. So anyway, the best thing you could do is really reread Reminiscences of a Stock Operator, Darvis's book. Yeah. Read a couple of the classics. Now, I have a hard time reading them because as I reread them, I get so excited because I know exactly what's going to happen over and over again. I get so excited, I kind of have to put the books down. I almost can't read those books anymore because it foretells the future, and the future's not going to stop. Again, as long as capitalism and free markets are pervasive here, this is going to end. I mean, the Fed's either going to back off and capitulate and back off or they'll kill inflation. And then we're going to have a raging bull market again, and people are going to get rich. I mean, that's just so. I went far astray. Don't think that the high RS like Church and Dwight or AbbVie, don't expect them to lead in the next cycle up. So study technology, study psychology. I don't have a great psychology book. I go to a shrink myself and I work one-on-one. They're a lot more expensive than books. But getting to know yourself is going to help you handle those next leaders so much more than anything else. I mean, it doesn't help you to get into a stock that's about to go up 300% if you don't know who you are and you're going to do something stupid like sell it up 10 points or puke on the first pullback. Everyone talks about fundamentals and buy points and what should we have. If you just bought the new high list after a follow through day and you were really psychologically wired in and knew your foibles and could have guardrails to keep you from that, that's going to make you rich. Knowing what the next pivot point is and all this stuff, that's not it. Okay. I think people spend so much time, what's the new leader? What's the perfect pivot point and all that? If you understand who you are and how to handle stocks in bad periods and how to handle them in good periods, and you have good money management, you're going to kill it. There's way too much emphasis on buy points. I wish people would turn off their computers and just do research all day and just look at prices on the close. If you did that, I think the average person would be so much wealthier and so much happier. The people who are like looking at these little, tick up and down like this, this is all ego. No, you don't need any of this. I think Bill O'Neil worked off of like one screen.
Yeah.
Darvis made all his money and he never looked at it. He never looked at a live quote. And when he moved to New York, he lost a lot of his money.
Right.
Right. Take the emotion out of it if you can.
Yeah. I mean, Darvis was trading almost 3 days behind on closing values by Telegram. And obviously he was able to do amazing things. And like you said, when he went to New York and actually had access to live quotes, that actually, I think he talks about that actually significantly hurt his performance. And he realized he operates a lot better when he's almost kind of like when he kind of closes himself off from the noise of Wall Street. That's when he performs his best. It's
the noise of Wall Street. It cues your enemy. It cues your emotions. When you're not looking at the tape and you're running 3 days behind, you don't know the stock pulled back. Mm-hmm. You didn't panic because he took emotion out of it. The number one killer to performance for almost everybody is fear. They puke right when the stock's bottoming. Now, if you have a stop loss, I climbed a mountain like 5 years ago, and there was a downtrend that occurred as I was ascending up. I gave my trader stops. I didn't get stopped out a single one of them. Had I been watching, I guarantee you, I would have, at the least, I would have trimmed. That was emotion. It wasn't acting on facts and price and volume. So the number one enemy of success in the market is not knowing yourself and emotions and acting, watching the little ticks, the up and down. Adam Sarhan calls it tickitis or tickositis or whatever it is. Mm-hmm. I mean, look, some people think the stock market's a slot machine and they want the action. They want to pull that arm and they want to buy and sell and all that. And if that's what you're in it for, kick ass. I'm in it to get rich. I want to hold and build positions in stocks that are going to go up 50 to 300% in a perfect world. Now, it's very hard to do, easy to say, but that's my objective. I could care less about making 10 points in a stock. It's irrelevant. I have been doing this for 30 years. I could tell you that I probably know a few dozen people who tried to day trade. Some were successful at it. 100% of those day traders, they're now called swing traders, are gone. They're out. Some of them, it cost them their money. Some of it cost them their marriage. And some of them cost more. Now, with the same 30 years, I know several people who've made $100 million or more. But they were all position traders. So you choose. What do you want to be? You want to pull that arm on that slot machine, feed that little machine and watch every little tick? Or you want to get rich? I mean,
right.
Well, that's a very small sample size of maybe 30 or 40 people, but it's real.
No, that's important to remember because action does not equal progress in the stock market. Often it's inaction that actually makes the most money.
Sitting, the big money is made in the sitting, Livermore. And the big money I've made in my whole life has been probably in like 6 or 8 stocks. And I've held almost all of them for 9 months to 18, 20, almost 2 years. Plus, every time you're selling a stock in less than a year, if you have a gain, you're paying 40% plus tax. If you hold it for more than a year, it's 20. And if your stock's going to triple, how many stocks triple in less than a year? How possibly? I did a study. The average length of a true market leader is 96 or 8 weeks. How, if you're selling a stock within 3 months, how possibly are you ever going to capture a TML?
Yeah, no, I 100% agree. And I think you've said it before, to really make the most of a trend, you have to hold through a couple earnings reports and ideally get some earnings gap ups along the way. And likely you'll get an earnings gap down, but you have to really hold it for that period to really get the full extent of the move.
If you have a stock, like I had NVDA on the very first breakout many years back, and I sat through like 6 earnings reports, that's a life changer. You have a stock have beaten 4 or more beaten raise quarters, and you have any kind of size in it, that's taking you to the next level. You're going to level up for sure on that one. Now, I was wrongly assumed that I needed to trim a little bit before every single earnings report. So even though it was a grand slam home run, it was a home run. But I trimmed wrongly in front of every earnings report, thinking I had too much size. Now, maybe I did, and maybe it was a smart thing to do, and maybe it kept me in because my size wasn't too big. But if I hadn't trimmed off 10, 20% in front of every report, it would have been so much bigger. But, I had a neighbor, and I told him how much stock I had a million years ago in a company that made Theraseed. And I also had an unbelievable monster position in my personal account in a stock called Siebel Systems. And I'm talking to this guy, and he's a very, very wealthy dude. And he goes, and I told him how much I had. He goes, Jim, he goes, I'm going to tell you, he goes, I don't know how much money you have. He goes, but he goes, I'll tell you this. He said, price will hurt you. He goes, but size will kill you. And he goes, the size you have on is, he thought it was too big for me. He didn't, he knew I wasn't wealthy. So that, price will hurt, but size will kill. And if you're too big, you can't handle the volatility. So maybe I was smart for selling some into those earnings reports. I don't know.
Yeah. Given what we just kind of talked about, I'd love to hear kind of your thoughts on maybe a leader that kind of started its run really, in 2020, like a Roku, which now is pulling back below its 200-day moving average. I guess my point is, given that we want to hold these stocks for ideally multiple years and get that full range, when do you kind of, what do you use to kind of identify character change where you probably want to sell some and lock in some profits, given that it's kind of had a change in character and is no longer a potential true market leader?
It's, I call the 50-day moving average the guardrail. Now, in a real run of 18 months to 2 years, your TML is going to break that 50-day 3, 4, 5 times, but it shouldn't break it too much.
Right.
You start living below the 50-day. That's your guardrail. You close on a Friday, 2 Fridays in a row below the 50-day. There's something going on that signals a greater. You get down to the 200-day, it's over. I mean, most likely. I mean, some people say you can buy at the 200 on a real monster TML. I really think the 50-day is going to be my personal guardrail. But also, these stocks, they run in unison. And people go, I'm diversified. I have Tesla, I have a semiconductor, and I have whatever, Starbucks. They're all growth stocks. When they crack, they all crack together. And when they start to crack together, I don't mean for a day or 3. It was very obvious to me the market had topped in February. It wasn't a secret. They all rolled over. They broke the 50s. They started living below. Series of lower highs and low. The trends turned down. Now, the problem is people make pets of these stocks. They're the first stock that they were able to buy their first house with. Right. So it's endearing to them, and they don't want to let it go. And then they don't ever stop following it. They'll follow it for 20 years. even though it peaked 18 years ago. So anyway, living below the 50, the whole, all growth names will peak together. It's really, if you experience will tell you, but if you don't have experience, living below the 50-day for periods of, for more than, say, you get more than 5-6% below the 50-day, or you spend a closing Friday or 2 closing Fridays below the 50-day, you've probably got an issue going on that needs to be addressed. And listen, you don't have to sell the whole position. You know, in a best case scenario, you trim someone that's really, really extended. Now, when it gets down to the 50 and you want to buy it, if it breaks hard, maybe instead of that, you realize it's really getting ugly and you get out of it, or get out of part of it. You know, I like operating like a dimmer switch. I turn it a little bit, I turn it a little, it's not on or off. Okay. I want to work around my positions. I'm very quick to buy big positions, but I'm slow. They got to work. The market's got to push me out. I don't ever anticipate. I will anticipate overvaluation or extension over the 50, but I'm not telling it it's topping permanently. So I won't just dump everything. I have a ratio in and out to, listen, profit maximization is an art. Getting in stocks is kind of a science. It's pretty simple, okay? But how you capture and how much you capture is an art, and it's predicated on experience and who you are and what you can tolerate in drawdowns. It's going to be pretty hard to have a 300% move up in a stock if you're not willing to take some wicked downturns. So you have to know, is the money too dear to you? Does it mean too much where you're going to puke at the bottom? If you know that, selling extensions is the way to go. But that's a hard game to learn. It took me, I've been doing this for 30 years and I don't have it. I never get it. I never get it perfect, ever. Right. Nearly never. There's people who say they don't get it right. And then there's liars.
Right. And I see on Twitter a lot of people, like you said, kind of still following the names that made them a lot of money in the past and kind of trying to buy in the downtrends and determine the bottom and pick a spot where they think it's going to turn. What kind of advice would you have for people who are trying to buy in these downtrends? What do you think they should kind of shift their attentions to? How can they improve their process?
Well, I think I did a study many years back, and I proved that over the last 50 years, there's a 3.7% probability that a TML will become a TML again. Like Tesla is just, it's such a outlier. It's like getting hit by lightning 3 times in 1 week. It's that rare. If you have a TML and it has a thunder move, there's a 97% probability or 96.3% probability that it's never coming back. Just know the odds. But if you're always buying stocks that are making new highs, you don't have to worry about it. Okay, the new high list is your gold bar. The market leaders are always going to be dominating the new high list. I mean, it's as simple. This is an oversimplification, but if you have a stock that's 50 and it's going to go to 300, what does it have to do all the way up?
Make new highs. Yeah.
So it's going to be, the leaders are always going to be in the paper every Sunday. It's guaranteed. It's like a dividing rod. It points straight to your leaders. Now at the minute, it's Church and Dwight and Freeport McMoran Copper and Mosaic. If your stock's not in making a new high every couple of weeks, you're in the wrong name. Or if it hasn't made a new high for a month or 2 or 3, you're probably in the wrong area.
Perfect. And I also wanted to just kind of re-go over the concept of cutting losses and why that's so important. And I know you've got to sign up on one of your monitors that says 357. I don't think I can see it here, but I'd love to. Yeah, there it is. Just out of frame. But I'd love to hear just based on your perspective and your experience, why is it so important to cut your losses, and keep your overall losses as small as possible?
Okay.
Relative to your gains, of course.
I was honest. I told everybody, I'm dyslexic. I was an LD student. I was not good at academics. I'm the least likely person in the whole wide world to succeed in the market. But there's one thing that always kept me in the game. I'm so disciplined about this one specific part of my life. I cut every single loss at I almost never, ever am in a stock down 7%, ever. And I mean, I sell a third down 3, a third down 5, and I rarely even wait for 7 anymore. Now I'm trading way, way bigger size than I used to, and I can't go just offload 100,000 shares at 3. The market, so at 3 I'll sell some, and then I'll sell 15% lots of what I have, so the market can absorb it, depending on what it is. I mean, Tesla, you could let it rip with 500,000 shares, and they're not going to move it too much. But the average guy can be very precise. You can put the orders and walk away. I have to work these orders. I can't just buy it all or sell it all at one price. But the simple answer is that I'm off track. It keeps you in the game. If you never fail on that one rule and you keep cutting all your losses, you're eventually going to stumble into an absolute monster. And that's what happened to me. I remember sitting at my dad's desk when I was trading like 100 lots for real. And I buy it here, sell it here. Ooh, cut it at 7%, cut it at 7%. And I go, someday I'm going to stumble into a monster.
Right.
And they sure as the sun came up. I hit many of them. Cutting your losses keeps you from being stupid. So many successful people who have money think they're brilliant, and they can't handle the ego damage of taking a loss, and it kills them. Cutting those losses keeps you in the game, keeps your ego in check. It's another guardrail. It's the 50 days of guardrail, but a much job one. It's so obvious and so imperative. I don't even discuss it ever. It's just it's if you're not cutting your losses, it's a rookie mistake. You're a new guy. No, anybody who's been around for 10, 20, 30 years who's making money, it's not even worth talking about. So must be done. Job one.
Perfect. Yeah, no, great. I just wanted to hear that. And I think that's an important lesson for everybody watching. Make sure you follow that. And
dude, I'm giving myself a plug. I have a podcast, and every Monday I have a rule of, I went to see Bill O'Neil between 1 and 3 times a year, every year for 30 years. And I took notes, and I have a stack of notes handwritten, like literally this big. And I have a list of his 80 most important rules. And I give one every Monday on my podcast at growthstockmentor.com. And oddly, I started doing this about a week ago. And out of just total coincidence, rule number 1, cut all losses at 7%.
There you go.
And it wasn't, I don't know why it was 1, but it was on my list as number 1 rule, but it wasn't meant to be organized like that. It just happened to be that way. So anyway, it is job 1.
It was subconscious.
Zero defect policy, buddy.
Yep, absolutely. And pivoting a little bit, I wanted to talk about, because earnings reports are coming out again over the next few weeks. I love to hear about kind of based on results and based on the price reactions, how would that help you interpret the risk appetite of funds and institutions?
Well, I'm afraid that the response to earnings is going to be in line with the trend of the market. Now, the first couple major important names report, their reaction could change me in a minute. Right. I remember many years back, the market was not a downtrend like this, but a downtrend. Things were very choppy. Apple reports, and the market embraced it. Big gap up, and it held. And then it started moving. I immediately turned from negative to bullish. And I started buying things. I don't suspect that will be the case this time. The Fed is crushing valuations, and I think even when great reports come out and these stocks get hit hard, it will reaffirm the trend. Now, I'm not saying I suspect that's what's going to happen, but I don't know. I mean, the first couple big reports, you have to pay attention to the reaction. Now, what's even better is after a prolonged downturn, a bad report comes out, and then the stock goes up.
Right.
When you have positive response to negative news, that is the best of all worlds. So, but we're nowhere near that right now. I mean, I actually, look, here's a rubber band. This is a bull market. This is going down, 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 down. This is a bear market. Now, if you just have a pullback like this, the recovery is like that. But if you have a pullback like this, the recovery is way bigger. I'm rooting. nothing would make me happier than a 50% pullback. That would be phenomenal. When the markets go down, you should all be getting excited because the opportunities are going to be enormous. I mean, don't think because we're having a bear market that capitalism is going away.
Right.
All right. I mean, unless Elizabeth Warren becomes president, we're good. Pray for a deep bear market. And the faster, the better. I would like Ryan Worch, my buddy over there, sleeping on the couch about an hour ago. He goes, I hope the Fed just raises 1.5 points, one shot, and kills the market. That would be the best case, but we're probably going to see a slower drip.
Yeah.
Don't get sucked in by value stocks. If you're trying to make 10 or 15%, whatever, buy them. Great. But they're not going to change your life. Wait for those boys to come out.
Perfect. And I think you've mentioned a couple times flexibility and how important that is for you to be able to just pivot and change your mind. Could you discuss about basically, basically that overall concept? Why is that good to have as a trader, to be able to change your mind based on new information, new price action?
I'm not that smart. I'm just a trend follower. I'm not dogmatic. I don't say, oh, we're in a downtrend today, Richard, and I think earnings reports are going to be bad. And then if the trend turns up and stocks having wonderful reactions to earnings, I'm not going to go, oh, I'm right, I'm going to fight this thing. I'm going to flex. I'm going to turn.
Right.
If you're just stuck in your opinion and you're going to fight the market, you never, ever, ever fight the market. It will steamroll you. Or like I'm out in cash. If I said, oh, the world's coming to an end, we're in a downtrend and the market turns up, I'm going to miss a big opportunity.
Right.
Like, I don't know. No one knows what's going to happen. Okay. If you look at the greatest traders in history, I think Michael Steinhardt was one of the only pure fundamentalists who'd never really looked at charts. He said, I think interest rates should be here and we're here, and I'm going to trade on fundamentals. I mean, the big monster, Buffett's a pure fundamentalist.
Yeah.
But the intermediate term traders, people who hold positions for 6 months to 2 years, they're all, almost every one of them, Druckenmiller, Soros, you name it, Paul Tudor Jones, they're trend followers. You can't have an opinion and hold it firm. You have to have a strong opinion loosely held. If you're not changing your mind, the market's going to pivot and you're going to miss it. Or God forbid, the best case is you miss it. The worst case is you fight it and lose.
Right. So
you have to be humble. I should be the humblest person in the world, and I'm not, because I choose golf, my relationship with my wife, and the stock market. That's how I value those things have all beaten me endlessly. Golf is brutal, and the stock market's even worse. If anybody you meet who's just arrogant and all cocky and says they're great in the stock, they're lying. Anybody who's been around for 20, 30, 40, 50 years in the market, it says, oh, I have no idea where it's going. And they'll tell you about losses and losing over and over again. And they'll say, yeah, sprinkled along the way, I had 8 stocks and made $400 million.
There you go.
I'm not saying I've made a bunch of money, but not anything like that. But
yeah.
You're going to have, I got stopped out of 29 of 34 positions in the first 3 quarters of last year. And you have one good stock. In the coming 3 or 4 or 5 years, I'm probably going to go back to the average of the long term, and I'm probably going to catch 2 or 3 stocks. They're going to triple, and I'm going to have big size, and I'm going to have 50 and 100, 50, 60, 100% years. I could care. It hurts my ego that I was down last year. It sucks, but I understand if I compound out at the way I have for the last 30 years, we're golden, man.
Yeah. One
down year is nothing. Now, right. I'm not talking about having a devastator down year. Don't ever doubt that this market is not going to come back with time. Now, the average bear market historically is about 6 to 18 months long. Now, in the QE environment, they've been about 3 to 9 months long. Like the 1998 global currency crisis was 38% down in 3 months. So and that's really good for us. Mm-hmm. Okay, we've had a lot of cyclical bears and secular bulls, which is I love it. And I think the secular bull is on, and I don't think we're anywhere near ending it. So I'm assuming we're in a bear market, okay? If this plays out, and the indexes haven't broke, the internals have, the mid cap, micro caps have, but if the big caps finally capitulate and we have a real bear, the indexes bear out down 20%, we're in a secular bull. I have every reason to believe this plays out. So, but I'm flexible.
Yeah.
Okay.
There you go.
I mean,
back to it.
I'm willing. I will trend. I'll trade with the trend. I don't care where it goes.
Perfect. And I think a lot of people are really inspired by kind of your optimism and your kind of belief in yourself and your system. So can you talk a little bit about that? What keeps you so optimistic, and how do you always seem so ready and so pumped up once the overall new uptrend resumes and you have so much faith that will happen?
Well, I didn't always have it.
Mm-hmm.
I earned it through repetitive implementation. I wasn't always confident, and I didn't know the system worked until I employed it. I gained the confidence through success, which reinforced that it worked. And listen, I went broke 3 times. Okay. I probably, because I was bullied a lot when I was a kid, I believed I wasn't worth making a lot of money. I don't know what it was. I wasn't seeing a shrink back then, but number one, you have to believe that that the system you're using works.
Mm-hmm.
You have to believe that you're worth it. You're worth making a lot of money. And you have to believe you have the discipline to implement it. And if you do it a few times, you now know these cycles repeat, and they're never going to stop repeating. And again, unless we change our method of the way we conduct ourselves here. I mean, it's self-reinforcing. It's like the football player who scores a touchdown is likely to score another one. The players never scored a touchdown is most likely not to score. Success begets success. So number one, you have to believe the system works. You have to believe that you can have a 100% year. If you don't think it's possible, it's not going to happen. And then you have to have the discipline to follow those rules. And I don't mean follow them for a week. I mean follow them for 30 years. You want to having one successful period does not guarantee another. You can easily screw it up if you jump off. If you lose your discipline or think you're smarter than the system or start interjecting other things into it, the system works because it runs on human emotion. Human emotion, DNA is not changing in humans. You may have high frequency trading. That's going to change the moment and algorithms. But if a company earns 50 cents this year and they're going to earn $13 in 3 years, that stock's going higher. I don't care if someone scalps a penny from you filling 100,000 lot. That doesn't matter to me. If an algo makes the stock go down for 3 hours or 3 days, if they're going to earn $13 up from $1, that stock's going way, way higher. So the confidence comes from, I know the system works. I know I can employ it. It agrees with me intrinsically. I mean, some people are way better off using a value system because they just want to buy bargains. They want to buy price to book. They want to buy something cheap. There's a lot of ways to make money in the market, but the method you use has got to agree with what's inside. So whatever your system is, you have to know it works. You have to have a little success with it and then just replicate it over and over again. That's oversimplifying things. But that's the basis of it.
Perfect. Well, no, that's fantastic. And Jim, I think I've covered most of the questions that I wanted to talk about that I've got written down. But is there any kind of other general advice that you'd have for the current situation when a lot of people are probably discouraged? They've either been stopped out of a lot of names or they're holding maybe a few losers that are below declining 50 SMAs. What would you kind of tell those people?
Number one, job one, cut your losses. If you have losses, just blow them out. Just get out. Number two, don't be in a rush. Don't force anything because you're likely to fumble and you'll put more pressure on yourself. Rest assured, there's guys out in their garages right now cooking up laser beams and space shuttles and all kinds of crazy stuff that's going to change our life and make it better. They're going to need money. They're going to go public. It's going to have massive revenue growth, sales growth, earnings growth, pre-tax, after-tax margins, make a perfect base and break out. They're never going to stop coming. So don't, and if you miss the first couple, don't sweat it. There's just going to be a litany more coming. Okay, so don't try to force money into this downtrend. All right, wait, be patient, be the lion stalking that gazelle. Go real slow. And when it jumps out, you just pounce on it. But don't let it come to you. Let that gazelle walk right into your trap. Don't chase it all over the place and expend all your energy. So when the real meal shows up, you're exhausted or lost all your will to fight. Be patient. They're never going to stop coming. And, protect your capital right now. This is not a get rich moment. Listen, I'm no short seller. Okay. If you're a long, optimistic bull trader, chill it and wait and be patient. I remember sitting in a Chinese restaurant 20 years ago, 3 blocks from here, and I had a full page article in Investors Daily in a stock called MAMS, Mid-Atlantic Medical. And the chart just went like this. And I kind of looked at it and I wonder if we'll ever see another one of those. That was 20 years ago. We've had like 15 every year since then. They're never going to stop coming. Why am I optimistic? Because I've seen it over and over again. And I have every reason to believe it's going to persevere.
Perfect. And I also want to open up the same question to Ryan, since he's in your room.
Oh, he woke up. He heard your name. Come here, man.
So obviously you guys are familiar with Ryan. We already had a market chat. Ryan, any advice for... Yeah, how's it going? Any advice for traders out there who are struggling right now and maybe are holding some stocks and downtrends? Any advice for those type of people to kind of help them out in this time?
Yeah, I think Jim covered a lot of those topics, and I think one of the things is you have to learn to cut losses. I think that's the most important thing, because it's the old adage in gambling: if you don't have any chips, you can't bet. So you absolutely have to keep your powder dry, especially in down markets, because he's right. We don't know where this is going to go. The markets could go down another 20, 30, 40%, or they could bottom today. We have no idea. But if you lose all your money trying to fight and catch a falling knife, you're not going to have any powder to play when this does turn. We know it will turn. Again, we just have no idea when it's going to turn. And I think another really good point Jim made, and you had asked him the question, how does he have so much confidence and why is he so optimistic? And I think he's 100% right. You have to earn it. There's no other recipe for success other than actually doing it, putting your own capital at risk, and really earning it. And if you do this long enough, which we have, I'm a little bit younger than Jim, but I've still been in this business for 21 years now, and we've been through plenty of periods where you feel like it's never going to end, and it absolutely rattles your confidence, and you feel sick and you feel like you want to quit. But the only way to get through it is to have the utmost confidence in yourself and believe that you can do it, and know that when we come out of this, it's going to create just massive opportunities. And again, through only time and experience, you really gain that knowledge, and you have to go through multiple cycles to understand it. Some people are just lucky and come out of the gates and make money because they kind of convince themselves that they're smarter than the market, but they just happen to get lucky in a bull market. Right. It's going through those bull market cycles followed by bear markets, being able to keep your capital, have the persistence and fortitude to make it through that, and then to make it again in the opportunistic bull market that typically follows, and it's the same cycle over and over again. Once you go through that, you've earned the right to be confident, and that's the only way to do it, quite frankly.
There you go. And go golfing in the short term,
that's
baby.
Right,
Let's go.
Right.
There you go.
It's true. In times like this, the best thing to do is to do nothing and go away and wait for opportunities to present themselves. And I don't, unfortunately, I don't think there's many opportunities right now. So, if it was nicer here in Chicago, we'd be
swinging these clubs, man, not indoors.
Instead, we're going to go get a big steak tonight and enjoy
predictions
ourselves.
Party, hedge fund manager predictions party tonight.
Correct.
Perfect. Yeah. And if you can't go golfing, go ahead and rewatch my previous interviews with Jim and of course with Ryan here as well. They'll be linked down below. Thank you both. Thank you, Jim, especially. And I hope everybody watching enjoyed this. If you did, please go ahead and leave a like down below and subscribe if you're new to the channel. And yeah, any last words, guys?
No, just you have to be an optimist, right? You can't be a pessimist. And as bad as right now the market is, it will get better. Just timing it is almost impossible, and we have no idea. Just, live life to your fullest.
Perfect.
Time is the most valuable thing we have. Don't waste it. Everybody, look at a monthly chart of GLD. I think it is the most elegant, beautiful chart I've ever seen. If that breaks out, I don't know what's going to happen. And as long as the golden goose of capitalism isn't suffocated by socialism, they're never going to stop coming. And everybody subscribe to Growth Stock Mentor.
There you go.
And get Adam Sarhan's book about psychology.
Yeah, I've actually got it on the on my table right over there. So perfect. Thank you guys
for the opportunity. Thank you for having us on.
Yeah,
of course.
And we'll do it whenever you want.
Yeah,
perfect. And I'll have both
your links down 2022.
Perfect. Thanks, guys. Take care, and we'll see you guys in future videos. Peace.